Look, here you got S&P going almost 6,800. Everything looks great on the surface, but the more I dig into the data, the more it feels like the ground under us is about to give way. I was checking gold the other day, and I noticed something in the gold to oil ratio that only makes total sense once you dig way deeper into it, which I ended up doing, and I'm going to show you that. It ties directly into metals, energy, and what's really happening underneath this market, and something actionable that huge global players are doing that I believe could potentially be a profitable trade in the future. At the same time, there's claims that trading algorithms may have caught a major fraud inside the AI sector. It found it in just 18 hours. That's part of today's story too. This is hands down going to be the best market signals episode I've done yet. If you're ready to dive in, be sure to hit the like button so the algorithm knows this content definitely needs to be seen by everybody else. Let's get into it. So here's what happened. I was looking at the gold chart the other day. You've got silver at $51, platinum at $15.64, and then I decided to also look into crude oil. It's around 58. When you look at all these together, basically all the precious metals have moved up this year, and the chart shape is about the same as gold. The chart is almost identical across gold, silver, platinum. So there's nothing really stand out right off the bat there. I decided to start checking the ratios. This is the gold to silver ratio. Nothing completely out of whack here like what had been seen back in 2020. More middle of the road. Gold to platinum, same thing. It's pretty high, but not near as high as it was a little earlier this year. But with the fact that gold and platinum have moved a similar shape, that doesn't stand out to me. This is what stands out to me. When you look back historically, an ounce of gold in the past would buy about 15 barrels of WTI crude. And more recently, it'd be in the mid-20 range. So an ounce of gold would buy about 25 barrels of crude. Right now, though, we're over 70 barrels. And the only time that has been higher was back during the crash in 2020. This is way out of whack. This is a huge discrepancy. This is going all the way back to World War II. So we're looking at a price multiple that is historic. This is an 80-year second place for 80 years. What that tells me is that oil is historically cheap relative to gold. And when I was looking further into this, I see that JP Morgan, as well as others, are saying that they think gold could plunge down into the $30 range by 2027. That doesn't necessarily mean anything, price predictions like that, but there's analysts believing prices could go lower. Maybe they want prices to go lower so they can buy more, but regardless, what we're seeing here, we got oversupply, softening demand. Between this, you've got gold extremely strong, oil very weak, and the ratio between them completely out of whack going back to World War II. This is where things get interesting, because next I see that IMF gold sales are among measures to tackle debt. There's these recommendations going that the IMF needs to start helping African debt-strapped nations. Next, I see the IMF is considering selling up to 10% of its gold reserves. This is not a rumor. It's being discussed openly in multiple articles. And the reason that they're giving for this is they want to use the money to help debt-strapped nations, especially in Africa. And look, I'm not saying that no one out there is really trying to help. Obviously, people try to help where they can. But when you're dealing with billions of dollars, giant institutions don't usually make moves like this purely out of kindness. So I started thinking, how does all of this play together? Why now? Why gold? Why sell when gold is at record highs? So I decided to start looking a little bit deeper into these countries are having trouble with debt. So how are they able to secure the loans? South Sudan confirms it has sought $2.5 billion in oil-backed loans. So Sudan is using their oil as collateral. Nigeria's $5 billion oil-backed loan from Aramco delayed by oil price. So Nigeria using oil. Angola, same thing. Uganda, same thing. All these African nations are using their cheap oil to secure this debt. And this is where the light bulb goes off. If these countries can't pay the loans, the lender will get the oil. So now picture this. The IMF is sitting here. They're thinking, okay, we've got gold at record highs, oil historically cheap, almost record level cheap. These debt-strapped countries might default on the cheap oil. And if oil is this cheap versus gold, this might be the best trade of the decade. When I think about it like this, it suddenly makes sense why they'd sell a piece of their gold right now. Not because necessarily they want to help. Maybe some of them want to help, but because it's a historically solid trade. All of this makes me think about the old quote from JP Morgan, the original JP Morgan, where he said that a man has two reasons for doing everything. There's the good reason and the real reason. So what I'm looking at here, I know that the good reason to do this is to help these debt-strapped countries in Africa. But I believe the real reason is to make money. And the way they're planning on making this money is selling gold at a record high and buying oil, or securing oil for the debt at least, which is effectively the same thing. I'm watching gold and the crude price every day now. I think anything in the 30s to 40s is where I would become interested. And granted, this is not financial advice. This is just what I would personally do. And I'm not recommending that anyone else do this. I'm just saying if it goes down in that level, it's going to be at record level. The gold to oil ratio is going to be record level. And I would definitely personally be looking at selling gold and moving the profits from that sale into an investment. I would probably do it into oil and gas stocks. When you think about stuff like what happened with Nancy Pelosi, it said she made $130 million in stock profits during her political career. Obviously, watching and listening to what the larger players are doing in the world, when we look at what the deal is with the IMF, they basically control all the money in the world. So I think whenever they start thinking about making a big move, selling that much gold and basically helping people with it, but what they're really doing is loaning it. It's going to be paid back and they're securing it with oil. Quick side note though, if you want to keep up with these kinds of signals every week, be sure to subscribe so you don't miss the next episode. Next signal I was seeing. Turkey prices are up about 70% this year. Not 7%, not 17, 70, right here, 70%. You don't have to be a PhD in economics to figure out that between the lines. If you've got a basic holiday bird up 70% in a year, something is not right with this system. This fits with everything else that we've been seeing. Gold nearing record highs, oil weak, ratios hitting World War II record levels, consumer credit stressed out to the max with higher costs all over the place. And speaking of that, let me know in the comments if food prices where you're living, wherever that may be, if you're seeing any kind of crazy surges, or if that's showing up anywhere else in your everyday life. Okay, now on to this big story with Nvidia, because you have to look at Nvidia regardless of whether you are an investor or you are even interested in investing in Nvidia at all. It doesn't matter. They are the largest company in the world by market cap, even after the more recent drop. So whatever's going on under the hood here matters for the entire economy and the whole AI bubble story. I saw the headlines. Their revenues look fantastic. $57 billion, earnings per share of $1.30. The stock explodes after hours, after they report the earnings at the close. But within 18 hours, the move was gone. The reason is in the details hiding in the financial statements. It's not in the headlines. So I'm browsing around X. This guy, Shinaka Anselm Pereira. This thing pops up. I read his breakdown. He's got a Substack also. Interesting article. I would definitely check it out. It's same name. Shinaka Anselm Pereira. He points out that receivables came in at $33.4 billion. And just for anyone who's not aware, receivables are the unpaid bills. They're sales that Nvidia already counted as revenue, but they haven't been paid for yet. So think about it like this. Nvidia ships their GPU. They book it as revenue immediately. The customer hasn't paid yet. That amount is now sitting in receivables. When the receivables get big, it means more of their revenue is just IOUs. So there's this metric that, and all of this is broken down in the Substack, which I encourage to read, but he breaks down this number, the days sales outstanding, DSO, which is just effectively how long is it taking to get paid. And to see how long Nvidia is waiting to get its money, you look at the DSO. When you plug in Nvidia's numbers with 57.01 billion revenue, 33.4 billion receivables, in a quarter length of 91 days, you get a DSO of about 53.3 days. Historically, Nvidia was around 46 days. So they've added a full week to their collection time, which may not sound like much, but all the competitors are lower. You've got AMD 42 days, Intel 38 days, TSMC 35 days, and Micron 44 days. So now Nvidia is on the slow side of this group. The reason that this matters is because it typically points to one of two things. First, it could be the customers are just slower to pay. Think about it like this. Nvidia ships their product, they book the revenue, customer delays the payment, receivables start piling up, the cash isn't coming in as fast. That's one case, DSO is rising. That's often a sign that their customers are under some kind of financial pressure. The other possibility is that the real demand is weaker than what is being publicly said. If like we're being told the demand is crazy, it's so good, it's insane was the exact word. The customers are going to be paying quickly and competing to pay. They need the product urgently, and they're not going to drag out the payment terms. But when the DSO is going up, it can mean that Nvidia is pushing their product out faster than the customers actually are needing it. Or again, it could be like I said before, where the customers take delivery when they don't have cash ready. On paper, that makes the revenue look fantastic, but underneath it all, the actual cash demand's weaker. I saw a number of comments in here with people disagreeing with this, but I read through all the numbers, and you've got the inventory went up from 15 billion to 19.8 billion, up 32% in a quarter. But if the demand is truly outpacing the supply, the inventory shouldn't be surging up like that. And then additionally, the claim that the demand is so great, when you look at spot rates for renting the H100 GPU, it's dropped from $3.20 an hour to $2.12 an hour. So the price per hour to rent these GPUs has dropped about a third, about 34%. And prices just don't fall like that if the demand is as good as what's being said. So altogether, you've got receivables are up, days sales outstanding, DSO is up, inventory is up, and the rental prices are down. And that isn't what insane demand looks like. With all of this, you've got Michael Burry from The Big Short. He's publicly reported put options on Nvidia. 140 was his strike price, and by next March. Peter Thiel's Thiel Macro Fund sold about $100 million worth of Nvidia stock shortly before all of this. And also SoftBank sold its entire stake in Nvidia for $5.8 billion. This was just a few weeks ago. I think those people probably knew some of this was coming. And when you look at the price, those seem to be pretty good bets because it's been dropping pretty much ever since the brief surge from that earnings report. On the crypto side, there's not as much news. You've got Bitcoin is still going down. It's down about 6% year over year. XRP's around 215, but some cool news. You've got two XRP ETFs. You've got GXRP launched, which is the Grayscale ETF, and then also the XRPZ, which is the Franklin Templeton. And the cool thing about this, it opens up more institutional investors to invest in XRP without touching the exchanges directly. Other news, you got HBAR price not doing so well on the year, but they put out a big update that they open a bridge between Axelar and Hedera, which effectively connects it to 60 other chains. They were excited about this. This allows cross-chain transfers, makes it easy to move assets between Hedera and other ecosystems. They also said Saucer Swap supports Axelar for cross-chain liquidity. I was reading about this on X, and this Nicholas Votero, who I wasn't familiar with before, but he did not seem happy about this announcement at all. His main thing, he was saying that Hedera already has strong native ordering and messaging tools through HCS, Hedera Consensus Service. He said Hedera should build its own interoperability on top of that and not rely on other chains. He said he doesn't like depending on Axelar's separate security model and token for such a core function. One of the main things he was saying is that if the HBAR integration is selected by Axelar builders, the outputs are limited to token minting transfers. I'll bet Axelar got funded without a coherent logic model to drive network outcomes for their optional integration. Shame on Hedera Foundation. Let me know, what do you think? Which side are you on this debate? Are you on Hedera Foundation side or on the same side as Nicholas Vitero? Put it in the comments. Moving past Hedera on Quant has not really much news at all. They're down to $86, which is down from this summer. They had been up to $135. But again, not really any news out this week. I'm just still watching the chart, and I'm going to keep up any updates in future market signals. Really interesting, something to tie it all together. Despite Nvidia taking a little bit of a dive recently, you've got S&P 500 knocking on 6,800. Deutsche Bank is saying S&P 500 is going to hit 8,000 by the end of 2026. I want to put that in context because there are going to be a lot of people that are going to read articles like this and they're going to say, oh, see, it's guaranteed. They could be right. Ultimately, nobody knows. But I want to go do some rewinding back to pre-Great Recession, back to 2007, where first, let me just show you the chart. So this goes from summer 2006 to the peak. This is for S&P 500. S&P peaked around 1560 range. And then here would be the January timeframe when the analysts were making their prediction. Right at that moment, S&P was at 1400. Nobody knew what was coming right down the road, but there was all these predictions. These were the predictions. Effectively, everyone was predicting some price between 1,500 and 1,700. That was the prediction. I want to point something out too. When you get predictions like this, the 8,000 by the end of 2026, I recommend everybody read this book, One Up on Wall Street by Peter Lynch. I read this book. I've actually read it twice, but I first read it a long time ago, about 20 years ago. And he points out in that book that analysts do not like to say negative things about the stock market because let's say that you just say overall, I think the S&P 500 is about to crash, or I think the S&P 500 is about to tank, and you're an analyst. If you're a successful analyst, you're going to have relationships with all the top S&P 500 corporations like Nvidia, Apple, Microsoft, Google, all of these companies. You're going to have relationships with all of them. And if they hear you saying that you think the market's not doing well, you're also effectively saying that they're not doing well. That if you think the S&P 500 is going to crash, that means their company's stock prices are going to crash, which makes investors not want to invest in their company, which makes those executive stock options not do as well. And nobody likes that. And it effectively, when analysts start coming out before the market has been tanking and they're making predictions it's going to tank, that is not well received by executives. And it's something to keep in mind whenever you hear these optimistic reports. I always say to look a layer deeper, always look a step deeper. That's ultimately what I'm doing with all these market signals. Regardless, with all this, we've got gold at record highs, oil looking weak, possibly going to be even weaker. The gold to oil ratio hitting almost record levels. Consumer delinquency is surging. Corporate cracks starting to show up in places like Nvidia. Consumer prices are still stretching. Yet a lot of the commentary is still upbeat and confident. But for me, that mix of stretch valuations, these crazy pricing signals, all this high confidence exuberance is exactly the kind of setup I pay attention to over and over again. If you're finding all this helpful and want to keep tracking these kind of signals with me every single week, be sure to subscribe so you don't miss the next one. I'm going to be predicting big moves ahead, and I'm expecting there's going to be all kinds of turmoil coming forward in the remainder of 2025 on into 2026. Everybody in the U.S., be sure to enjoy your Thanksgiving. Be safe. Everybody outside the U.S., enjoy your weekend. And everyone in general, be sure to check out this next deep dive of mine that YouTube is specially picking just for you. I'll see you in the next Market Signals.